get some analysis of all that's going on out there. Fraser MacLeod from Shaw Partners is joining us. Perhaps we can start big picture, Fraser, because you've decided that this recession that we're emerging through is not going to be V-shaped or U-shaped or even L-shaped.
Well, yes, thanks for having me on, Nadine and Scotty. It's the end of, or getting towards the end of reporting season, and I guess everyone's asking, what have we learned from that? And it wasn't so long ago. It does seem like this has been a very long year so far, but it wasn't so long ago, back in sort of April and May, that everyone was really discussing and really arguing over, is this going to be for the market and the economy? Is it going to be a V-shaped recovery? Is it going to be an L-shaped recovery? Even Dr. Doom Nurbini, he was saying, no, this is going to be an I-shaped recovery. There is no recovery. It's just going to go straight down this market. And none of that has really been true. So what is happening and what is becoming quite clear is that the market has delivered a big fat K shape, meaning that the gap between the winners and losers has just got wider and wider and wider. So the winners are getting stronger and the losers are getting weaker. The winners obviously are growth tech, especially, and anything to do with value or value labels, anything to do with travel, anything to do really more for most financials has been losing out. And we saw that even last week, consensus price targets. We saw big upgrades last week from the likes of techs like Altium or WiseTech. Even you would Domino's Pizza like to think that they're a tech company rather than a pizza company over the past few years. But so big upgrades there, upgrades as well from things like JB Hi-Fi. But you see just more grim news and more softening off in share price coming out from the likes of, say, AMP or Challenger, still in trouble, or even Whitehaven yesterday. These share prices are just continue to soften off, and people are really just asking, why should I be there? So winners getting stronger and losers getting weaker is the obvious sort of look back over the course of the past month.
Fraser, it's interesting you mentioned Dr. Doom. I was listening to Mark Faber on a podcast on my way into the office this morning. Maybe helping you cheer myself up a little bit.
Yeah.
When it comes to playing this K-shaped recovery, now winners and losers, are there some examples you can give us as to companies that you believe are going to be the winners and the losers that operate in the same space?
Yeah, sure. Look, I think that so within the same space, the easy one that for many investors across Australia to look at would be CBA. CBA continuing to pay out a dividend, probably the most that they could. And CBA, that's a sector that has its challenges and its troubles. But against Westpac, we would much rather be holding CBA. So there's the up and the down leg of the K there. So stronger getting stronger in that CBA is handling the problems a lot better. Westpac not paying dividend, more troubling increase in bad loans that they're having to provision against. Their 90-day past due is looking pretty ropey. And CBA, look, there's probably a good 10% at least in terms of price target that we would still have on them on the upside. Other places to look, it's not to say that every winner is still a decent stock that we would prefer to buy. We have had a great love for Fortescue over the course of the last the last few years, and by gum, it's an amazing stock. It's had a record profit, record sales.
Record high today, Fraser. Record high today.
Record nearly $20, not $20 yet, but look at our price target on Fortescue is only about $15, and it's trading many dollars above that. So they back in 2013, I think it was, they had $10.5 billion of debt. Today they're pretty much net cash. I think that their debt at the moment is about $250 million. So they're almost net cash, and that's an incredible recovery story. But there's so much that's already factored into the price. So we have to look at the iron ore price and think, well, it wasn't so long ago. Back in July of 2019, the iron ore price was trading at, say, $120 a ton. The next month, the month after that, by August of 2019, it had dropped 25%. It wouldn't take much for this iron ore market to fall over again. There's a huge difference between the real growth that's happening in the world and where the iron ore price has been. And there might be technical reasons behind that, but we don't think those are long-term fundamentals to be betting on. So not to say that every winner is going to stay a winner. That's just the pathway that we're looking at and we're really quite careful of. Other stocks, you look at things like, say, Wesfarmers. Wesfarmers is an easy one to look at. There's 14 different analysts. It's very well covered, Wesfarmers, 14 different analysts in our market. Do you know how many have a buy on them? None.
Yeah.
But nobody wants to sell Wesfarmers. We don't really want to sell Wesfarmers. It's pretty much trading up where we think it should be trading, but it's very, very hard. It's a very difficult stock to sell at the moment, and it's also a very, very difficult stock to buy. So there's probably a hold for you that's at the top end of the K. But probably more troubling is those that are on the lower end of the K, on that lower leg, because those stocks are ones that have weaker balance sheet, or smaller, would find it trouble in order to raise cash easily, and ultimately this is going into next year. You'd rather probably have an up leg K with good cash flow than a down leg cheap stock, because cheap stocks can turn into problem stocks real easy.
Okay, well, you've painted a picture of this K in my mind anyway, Fraser.
Okay. Fraser, let's talk AMP. Obviously, it's been a lot in the news over the past week or so. Where do you stand when it comes to the diversified financial?
Look, we don't like the stock at all. We haven't done for many years. There's just continuing problems there. We see no reason to be there at all. Look at our analysis on it is that you wouldn't touch it. Our analysis on it as well is that no one else is going to touch it. So it's not as if you're leaving the stock and thinking it's going to be taken over soon. That there just is continuing problems there. The engine room, or the wealth management business, the engine room of AMP is broken, and we don't see any reason to be there at all. So it's a firm sell from us, and it continues in that pot. It's hard to even really see where the positive catalyst can come from. There's too many horrible news bombs that have hit for AMP, and I wouldn't risk anyone's money with it.
Okay, Fraser, so the market at an index level seems to be limping toward the end of the week, as perhaps some of us are as well. Tomorrow, though, the fun starts again, and we'll be bright-eyed and bushy-tailed for it. We've got AFG Group, we've got NextDC. That's an interesting one. What are you looking forward to still? If it's not tomorrow, what are you still looking forward to in this reporting season?
So, look, NextDC is an amazing company. I remember back in the day handling the float of NextDC, and it's a lot of these small tech independent names. That's from the Bevan Slattery camp originally. The demand for products like NextDC's, or even probably more important, as a company like Megaport in the rise of the cloud, especially amongst lockdown countries, has been just enormous. So you've almost got that effect that the growth that was to come has just been accelerated forward. We're really in 2025 rather than 2020 on where the growth rate has ended up, just in the space of a few months. I think that the main point to be cautious on is and careful now, is that the market as a whole is trading on 20 times forward earnings. The market here in Australia has never, ever, ever in anyone's lifetime traded on 20 times forward earnings for the market as a whole. So as interest rates have fallen, growth, or anything that can deliver growth consistently and with hope, has just been re-rated higher and higher and higher. But and anything that's delivering low growth just gets priced lower and lower and lower. So you'd probably still rather to be holding on to those higher growth names, but watch out on the technicals for it as well, because when things do correct, there's going to be a price to be paid after, I think. So we'll see on those. Yeah.
Yes, it could well be savage indeed, that correction when it does occur. Fraser MacLeod from Shaw & Partners, always fantastic to get your views. Enjoy your afternoon.
Thanks so much for having me. Okay.
Thanks, Fraser. See ya.